Today, the great mortgage interest rate race. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Today, I'm joined by Steve from Canstar. Hi, Steve.
Hi, Martin.
Great to have you back on, and I see you're back in your office.
Yeah, for the first time, and it's got to be about 6 months, and it's great to be back, but I've had to do a bit of a clean-up of past use-by-date stuff.
Yeah, stuff walking out of the fridge on its own, I suspect.
Oh, yeah.
Now, I wanted to pick your brains because there have been a lot of movements on mortgage rates. And the situation is actually quite confusing because we are seeing banks continue to put the fixed rates up. CBA did more this week, others have done it as well. But there's also some funniness going on with some of the variable rates too. So what's the story of what's going on with interest rates for mortgages at the moment, Steve?
Yeah, look, it's a fixed rate story at the moment with a little bit of variable rate stuff. But the fixed rates, we've seen 282 fixed rate movements in the 3 weeks of February. Massive number of increases. And have a guess, they're all up, not a single decrease in fixed rates. Variable rates have been a little bit different. Variable rates have been moving down in a couple of cases, a couple have moved up. But what the banks are doing effectively is saying, look, our cost of funding fixed rates is rising. We have to cover that. We've got to cover that in our margin. We can't afford to expose ourselves for that for the next 3 years or 5 years. So they're adjusting them twice a month sometimes. And just to make sure that they don't get locked in, but they're prepared to give margin away and keep margin skinny on variable rates because they know that come increases in the Reserve Bank cash rate or other conditions in the market that put their cost of funding up, they can bump those up whenever they choose to. So that's why we're seeing some decreases. One of the most interesting moves, I guess, is that the Commonwealth Bank a couple of weeks back reduced their investment rate by, I think it was 40 basis points, 0.40%. Now, that's a big move, and it says, look, we expect investment to remain running hot, and we want to make sure that we get our share of that market. So that's what the banks are doing. They want to win market share. They don't want to win it where they'll be locked into substandard margins.
Yeah, and it's interesting because the ANZ executive came out this week and basically accused the rest of the banks of, well, frankly, mispricing their books?
Yeah, look, it's hard to say from the outside whether that's the case or not, but I mean, he must feel that they're pricing too low on the variable rate. And you know what? It's possible that they are. It's possible they are, knowing full well that they'll be able to sneak through increases later on.
Yeah, of course, that's the point. If you're on a variable rate, it's not locked to the cash rate. The banks can move it up or down whenever they want.
That's exactly right. And you've got to, I guess people have to, it seems an unfair contract, frankly, doesn't it? You know, you borrow at a certain rate, the cash rate's a certain figure, the bank's lending at, sort of 1% more than the cash rate or 2% more than the cash rate, but they're not tied to the cash rate in any sense. You've signed a contract that says if the lender chooses to bump up your rate, they can bump up your interest rate. And there's no argument about it. They just can do it. Now, the reason it is that the banks are borrowing money on call or with a 1 year maturity or something, and they're lending for 30 years. So they have to have an open-ended contract. But it does mean that people are exposed when they borrow variable, they're exposed to increases in the interest rate, whether it's the Reserve Bank saying it's gone up or just the bank saying, well, we need to improve our margins a bit. So, be aware of it. It's important that people get that and that's the sort of contract they're signing.
Yeah, it was interesting because Rod Sims, the outgoing chair of the ACCC this week, said that it was very hard for anybody to get any transparency on mortgage rates. So the first point. And the second one, he was suggesting that banks should be required to write on a regular basis to their customers as to what the best rates are so that people know they should be looking to switch.
Yeah, look, we would love to see that happen, but that's not going to happen. I don't believe it will be. It's just, it's not something that the banks would want to encourage. They like the idea of having a hierarchy of rates, and they'll have cheap and cheerful loans, and they'll have fixed rates, and they'll have variable rates for. There is the Rolls Royce of their loan book. Now they love to get people into the Rolls Royce, where they can be paying, sort of 0.8% more than on the cheaper loan that the bank provides. It's not in their interest to get everybody to get their whole book into that variable rate that's the lowest. And they've done an interesting thing though at ANZ, because they have just scrapped their for sale. They've just scrapped their break-free package loan. Now that's their Rolls Royce. So they're not going to sell that anymore from, I think it's March sometime. And come September, they're going to migrate their customers away from that higher rate to the cheap rate, that's their cheapest rate. Now, it's not quite that straightforward. It's not like they're saying, look, we'll carve our existing customers' rate from 3% to 2.2%. That's not going to happen. They price their basic loan from a higher number and provide a discount. Now, the discount available for new borrowers today is a pretty big discount, 1.3% or 1.2%. Existing borrowers are going to transfer at the current package discount that they have. And for all bar people who've signed up in the last 6 or 12 months, that's been about 0.7 or 0.8. So their existing customers aren't going across at that lowest basic variable rate. They're going across still at a higher rate. So I think there's going to be, people are going to have to ask the question when they get that letter in August this year, what rate am I getting and what rate could I get if I was a new customer at ANZ? And then they have to approach their bank and say, look, I expect to be priced the way new customers are. I've been making my repayments without fail every month for 3, 5, 10 years. I expect the best rate. And people must chase up and say, that is my expectation. And if I can't get it with you guys, I better go somewhere else. So look at Canstar before you make the call. And I know it's 6 months off, but nevertheless, think about it now. You do your homework, go in knowing full well what rates are available both at ANZ and elsewhere in the market, and then say, I expect better.
It's the old loyalty tax, isn't it? People are just stuck on rates that they shouldn't be stuck on. And it's interesting because, of course, ANZ was almost obliged to remove that package product because of some of the issues with the fact that people weren't getting what they expected to get. And so there was actually regulatory pressure to remove it. And they've dressed it up as being simplification of their book, but actually there was another reason too.
Yeah, there always is. The problem, packages when they first came out were an amazing deal because the banks were lending at that stage, this is about 30 years ago, the banks were lending all their money at what is called a standard variable rate. Now, it's not actually a standard rate, it's their maximum rate. That's sort of 4-point-something% these days with most of the banks. And they brought out a package that gave a 0.7% discount and you had to pay a $600 fee, but you also got a free check account because transaction accounts were costly then, and you got a free credit card, also costly. So it was a great deal at the time, but it's now ceased to be a great deal because people are paying, $300 package fee. They're getting a credit card that's way, way, way away from the best in the market, and they're getting a free check account, free transaction account, but so is everyone else. So yeah, it's sort of it's been a way of kind of pricing up and getting fat margin on your back book, because all of their new customers were actually saying, well, you know what, we actually want to go to basic variable.
Yeah, well, people listen to us, Steve, and try and go for the best rates. There's a surprise.
Oh, yeah, well, and more people are too. People are becoming more aware. It's great because sometimes you think, oh, gee, I'm banging my head against a wall, but refinances have been up over the last 12 or 18 months. Still not high enough in my view, but they've been up. And so people are starting to get the message. I think when you've seen rates fall for, what are we now, about 12, 13 years, it's all been one-way traffic. When you see that, you kind of think, oh, look at the deal I'm on. I'm only paying 3%. Wow, I remember when I was paying 8% on that loan. So people think, well, I'm on a great deal, and what they haven't been aware of is that, gee, there are loans out there for 1.7%. So you're leaving an awful lot on the table there. That's a couple of $100 a month on the average mortgage. So when rates are falling, people aren't that sensitive to it. Come rate increases later this year, I'd say, people will start to see, gee, I've got to pay more. I wonder if there is a better deal around. So I think we'll see more awareness over the next few years as a whole generation of borrowers who've never seen rate increases will actually start being hit by higher repayments and rate increases. And welcome to the world that you and I remember for most of our adult borrowing days.
Yes, I can remember rates much higher and going higher still and worrying about whether I can afford it or not. And it's interesting because, I talk to a lot of people and a lot of them have never seen that, right? So they've always been in the decreasing interest rate environment, so they can just borrow more and more. We're in a new world now, and that paradigm is going to be quite different to navigate. Yeah,
look, I don't think they're going to get to the 20% that we were paying way back in the Hawke-Keating years. But if we don't get to at least 3% higher cash rate over the next few years, I'll be very surprised. I guess the world keeps throwing new googlies at us, doesn't it? We've got the Ukraine situation and the potential for shortages in oil and a recession induced by increasing oil prices, et cetera, et cetera. And, those curveballs just keep coming at us over and over again. But, just when we think we're going to get out of this, we're moving towards full employment, inflation's taking off to a nice, gentle 2 to 3%. And you think, oh, gee, I hope this doesn't actually hurt us yet again. But those sort of socioeconomic, political disturbances aside, it's hard to imagine that we won't be up with a cash rate around, 3.4, 3.5%, 3.5%, 3%, whatever. And 2% onto a cash rate adds about $500 to a $500,000 mortgage. And that, of course, the point is because the rates are so low, so even small increments up have quite a big financial impact in terms of the additional repayments. Westpac came out and said they're worried about some of those people who are on very cheap fixed-term loans for 1 to 2 years, but in a few months they're going to have to actually reset, and they will be resetting between 1% and 2% higher. That's a big number. Yeah, it absolutely is. And, I look at this fixed versus variable all the time. And one of the problems at the moment is that, you think rates are on their way up, it's time to fix. Now, it's too late to get the best deals, of course. Is it too late to do it? Well, it's a tricky scenario because right now, if you fix for 3 years, you've got a bit of protection going out. But you've got to pay, I've got the numbers here somewhere, but it's about 0.7 or 0.8% more at the major banks, at the big guys, more than their lowest variable rate. Now, it's going to take a couple of years for your rate to get, for the variable rate to catch up with the rate that you've locked in. And then you've only got 1 year of protection when you're actually going to be lower than the new variable rate. You've already paid for it up front, is the problem that you've got. So you can say, well, I'll go to 5 years and that way I'll get 3 years worth of protection. And for 5 years at the big banks, you've got to pay 1.3% more than their lowest variable rate. It's going to take you ages to get ahead, frankly. You'll be paying 1.3% more. That will be gradually whittled down, but it might take 3 years, 2.5 years for the variable rates to catch up with that. Then you've got to make hay and hope that you've made the right call and the variable rate will end up 1 or 2% higher and you'll have 2 years worth of protection. Well, maybe you won't get that. You'll look clever if rates go to 7 or 8%, but not so clever if they go to 4 or 5%. Yeah, of course, people think of a fixed rate as some sort of insurance against those moving rates up. But if you're having to pay so much more, what you're doing is front loading that risk, right? Yeah, exactly. And there is certainty at this stage that you will be paying 1.3% more. There's not certainty in 3 years' time that you'll be paying 2% less. So, you're sort of paying for it up front doesn't really make a lot of sense for a lot of people. The only rider I put on it is that if you're worried about being able to afford repayments down the track when rates go up, and you should be at least cognizant of it. So if you're worried about that, at least you can lock in now and say, look, I know for 5 years I'm not going to have to pay any more than this, and I'll worry about beyond 5 years after that. But it's a big call at the moment. You also will be in a position where, well, if rates go up, you won't have much in the way of break costs, but you are somewhat restricted with a lot of loans about how much you can actually repay extra. And, in 5 years down the track, you might regret that you haven't been able to make extra repayments. So you've got to consider those aspects as well.
And I actually think that forward paying thing is very important. People haven't realised that quite often there are significant restrictions on those fixed rates as to what you can pay ahead, whereas there's more flexibility on the variable side. Yeah,
that's right. The issue with fixed rates is that the way the bank funds them, they effectively will if they write $1 billion worth of 3-year fixed rates, then they're going to want to raise 3-year money in the wholesale markets to cover those loans, so that they don't end up making negative margin on the loans. They don't take that sort of interest rate risk. If rates go down and people have made extra repayments, then the bank loses that stream of income at the higher rate, but they still have to pay away on the loan they've taken out to fund the loans. So they're very exposed. So that's why they limit the amount that people can actually repay early, and certainly stop people from repaying early in total without the penalty, which is called the economic cost that compensates the bank for that lost margin.
Yeah, and it is important that people understand those, hidden things. Again, it's not transparent, but that's why it is the way it is. And there's another question as well, Steve, isn't there, that actually the amount of equity you have, or your loan to value ratio, also can determine the best rate you can get.
Yeah, it does, and this is one of the other issues that can drive people to a point where they do have to refinance. Because let's say you borrow with a 90% loan, then at a lot of the banks you are paying a higher margin. You're also up for insurance, and I'll talk about that in a minute too if that works. But you actually are paying a higher interest rate. Now, in 3 years' time, there's a pretty good chance that through property price increases, and also because you reduced your loan somewhat, you will actually be back to 80%. But the bank doesn't necessarily knock on your door and say, oh, look, we've noticed that you're probably below 80% now. We'll cut your rate by 10 basis points. That doesn't happen very often. And you're sort of locked in on that rate, on the initial penalty that you had to take a higher rate. You're locked in, even though now you might be down to 70%. So, these things can drive people to the point where they have to go outside their existing bank and say, look, I'm getting a better deal just by going in as a clean skin somewhere.
Yeah, well, we keep saying shop around, keep shopping around. And I would suggest that even now it's still worth shopping around, because the other factor to bear in mind is that the big guys tend to be less competitive generally than some of the other smaller organisations that are out there.
Yeah, they always have been, and they still have 70 to 75% of the market, and it's sort of one of those strange anomalies. You can't imagine another market that could operate this way. But people think of financial services, and one of the things that they do think about is big brands, reliability, knowing they'll be around when I've got a problem, knowing that actually they do have a branch network, a distribution network, so that if there is an issue that arises, I can actually talk to a person rather than actually just going online. So all of these things do drive people to those big brands, and that's why they bank with them, even though they might be paying, even for the lower rate loans, the banks have, 0.2, 0.3, 0.4%, even more than they get elsewhere. I get that with deposits. Would you go to a brand? Would you go to Acme? We'll take your money, thank you. To deposit your savings? Well, probably not. But when you've taken out a home loan, you're the one that owes the money. So it's even if something goes wrong, there's a pretty good chance that your mortgage will be bundled up and sold to another lender. So it's not a big risk like an investment risk or a savings risk. So people have to be aware of it. Also, I mean, don't forget that ASIC does look over the shoulder of lenders. APRA looks over the shoulder of most of the lenders as well. So you've got to look at rate. You do look at the reputation of the company as well. You do look at the other features that are provided, but don't pay a ridiculous premium for too many of those things.
Absolutely. And again, it's interesting, if you look at the satisfaction ratings of customers, right, the satisfaction ratings tend to be higher for the smaller organisations, which tells you something quite interesting.
Yeah, we do satisfaction ratings. Some of the big banks get pretty good scores, and some of the little guys do exceptionally well. The second tier, for example, and that's a pretty good indication of just how people are feeling, because when you think about the first loan you take out, you go to a broker these days, but prior to that, and still people say to family members, to older friends who've already done the deal, where should I go? Who'd you borrow from? And sometimes I'll say, oh, that guy around the corner in that little shop front, that broker, he's great. Did a great job. Others will say, look, I borrowed from this company. I got a really good rate, and they were slick. I got the money fast, etc., etc. And word of mouth on steroids through the surveys that we do is actually really powerful, because that's what people are telling you. People are saying this is a great place to borrow.
Absolutely. And you touched on it earlier on, but we'll just come back to it. Above 90% or 80%, right? There are extra things you have to do if you want to borrow. Lender's mortgage insurance being perhaps the most misunderstood and probably one of the most unfortunate inventions that have been brought into the market, frankly.
I shake my head at it, and the positive on it, I'll get that one out of the way, is that it does help people get into a loan when it would take them too long to save the 20%. So that's the positive. Is it the only way for it to happen? Well, probably not. I think there are other solutions. The issue is that when I take out insurance for my car or my house or my life, I expect to get a payout if something goes wrong, and it meets the conditions of the policy. I expect to get paid out. That doesn't happen with lender's mortgage insurance. The lender is being protected, not you, the borrower. So what it's saying is that if Steve defaults on his loan and the bank can't get enough back by selling the property to cover the loan, the insurance company pays the bank for the amount of the shortfall, not Steve. Now, that helps the bank to lend, and Steve gets his loan, and he sort of says, well, okay, at least I'm in the house. But it's actually increased Steve's risk, because now Steve's had to borrow extra money against the house to pay the premium on the lender's mortgage insurance. And it's $10,000, $12,000, $15,000 is a pretty usual sort of premium for lender's mortgage insurance. So Steve's had to borrow $15,000 more. Now he's a higher risk borrower than he would have been if they just lent him the money outright. So there's some real problems with the whole concept. Steve's risk increases, the bank's risk reduces. It's one of those imbalances.
And of course, even if they pay out the bank when things go wrong, they can still come back after you. So you're not protected at all.
No, you're not. I forgot to mention that, because that's important too. At the end of the day, all it is you'll have a different debt collector knocking on your door. It won't be the bank, it'll be the insurance company.
Yeah, so I've always said to people, be very careful. That's why the bank of mum and dad is quite often being used as an alternative these days. Yeah,
well, mum and dad can get defaulted on too, of course, and but they don't have the protection, and they're probably not likely to take you to bankruptcy. And but the bank of mum and dad, it's become increasingly important, and especially now. I mean, if property prices in Sydney, Melbourne are up around 30% on a year ago, and putting together that deposit is horrendous. So, if you're fortunate enough to have mum and dad who can actually put their hand in their pocket and come through with the cash, well, that's a great thing, and it does take a lot of pressure off. People have to understand the expectations, both sides. Is this a loan or is this a gift? If it's a gift, fine, everyone's happy, and provided mum and dad can afford the gift, that's great. If it's a loan, understand it's a loan. Talk about when it's going to be repaid. Agree the terms, agree the scenarios that could get in the way, etc., and then document it, because it's amazing how memories are blurred and everyone remembers a slightly different version of what was discussed. And in the excitement of getting into the new house, they forget all of the detail. So just make sure that everyone is on the same page when it comes to the bank of mum and dad. And if mum and dad need that cash to retire on, then it's not a great solution. It's almost always it's not a great solution, because interest rates go up and suddenly the expectation that they could repay both loans, it's out the back door.
And of course, if you've got multiple kids, it gets even more complicated.
Yeah. Oh, look, I only lent to your older sister because she's our favourite. It's not a great story, is it?
It is crazy. Steve, that's been really, really helpful, I think. And, I guess the bottom line is shop around, know what your mortgage rate is, and be careful and cautious. Don't just jump into the first one that comes along, because it may not be the best deal.
Yeah, absolutely, Martin. It's the same old story. I guess we keep beating the same old drum in a way, but the nuances and the colour all change, but the theme always stays the same. It doesn't matter what's happened in the market. The theme's always the same. There are some great deals out there. They're not always going to be put on a plate for you, so you've got to shop around. You've got to do your homework and make sure that you find the great deals, and then look at the fine print to say, now, is there any other trap or risk in this that gets me locked in harder than I thought? So, shop around always.
And Canstar provides a great service with all of the listings there. So we'll put the links below. Steve, appreciate your time once again. Always great talking with you. And we'll do it again soon.
Yeah, terrific, Martin. I always enjoyed this.
Cheers. Thanks. Bye-bye.
Thank you.